Good morning, good afternoon, good evening, and welcome to the 6th episode of the Insights on Digital Financial Services during COVID-19 webinar series organized by the ITU. We hope that you, your family, your friends, and your colleagues are all keeping healthy and safe. My name is Bilal Jamousi, Chief of the Study Groups Department at the Standardization Bureau at the International Telecommunication Union in Geneva. And it's really a privilege for me to introduce today's webinar on digital currency and financial inclusion. This episode is the first of 2 episodes on digital currency. Before I introduce the panelists, I'd like to provide some general information concerning the logistics of today's webinar. We have some 100 participants connected at the moment from different countries, more than 200 registered, so we expect more to be joining us. All the presentations will be available after the webinar on the website of the event. I'm pleased to inform you that we have captioning in French for the webinar today. To turn it on, just click on the closed captioning at the bottom right of your window, and you should be seeing the French captioning under the window. All questions from participants will be taken at the end of all presentations during the Q&A session. Participants can submit their questions by typing in the Q&A window. See Q&A icon at the bottom of the screen. When submitting a question through the Q&A window, invite participants to type the name of the panelist to whom the question is addressed, followed by the question. If the question is addressed to the entire panel, please simply type your question directly. The webinar is being recorded, and the recording will be made available on the webinar page later this week. Let me introduce our panelists. Our speakers are Mr. John Kiff from IMF, Mr. Ahmed Faragallah from the World Bank, Mr. Rafael Auer, Bank for International Settlement, and Mr. Klaus Lober, European Central Bank. In this episode, we will examine the different types of digital currency and the potential for digital currencies and central bank digital currency to bridge the financial inclusion gap. The ITU focus group on digital currency, including digital fiat currency, which concluded its work in June 2019, almost a year ago, brought together the ecosystem stakeholders, central banks, telecom regulators, digital currency platform providers, payment system providers, and international organizations to discuss this fascinating subject. The focus group developed a glossary of terms used in digital currency and also a reference architecture for different implementations of central bank digital currency, CDBC, for retail, wholesale, and cross-border payments. Central banks are considering CDBC for 2 main reasons. First one is the declining use of cash in advanced economies and financial inclusion in emerging markets and developing countries. COVID-19 could accelerate a shift towards digital payment. The policy concern for many countries would then be a digital divide where unbanked customers may be left out of the financial system. Digital currencies are an innovation that could have a range of impact on various aspects of financial markets and the wider economy. These impacts could include potential disruption to business models and systems, as well as facilitating new economic interactions and linkages. In particular, the potential implications of digital currencies on retail payment services seem to be especially important, as these schemes have the potential to facilitate certain retail payment transactions. Example for e-commerce, cross-border transactions, and person-to-person payments, and possibly make them faster and less expensive for end users, such as consumers and merchants. Digital fiat currency, authorized and issued by a country's central bank, is recognized as legal tender and can be viewed as the digital equivalent of banknotes and coins. The adoption of digital fiat currency is expected to drive the expansion of the digital payment ecosystem by offering a secure, interoperable payment instrument suited for our increasingly digital world. Most of the CDBC design options are based on distributed ledger technologies and can help the development of DLT-based asset markets and cross-border payments. Central banks, digital currency, and other digital assets have been mentioned as a tool that could improve the delivery of government funds to those most in need. There have been proposals for retail CDBC. Each of us could hold an account with our central bank, which could deposit CDBC directly in our digital account in times of need. We would no longer need to rely on traditional commercial banks to approve paperwork for emergency funds. Our central banks could automatically put emergency funds into our personal or commercial digital wallet. The focus group on digital currency, including digital fiat currency, also considered the financial inclusion angle for CDBC. CDBC could help ensure equal access to a means of payment for all citizens, thereby favoring financial inclusion. But other solutions also exist and may be more efficient. A lot here depends on the barriers to financial inclusion. For instance, cash may be difficult to obtain and use in rural areas. As a majority of the population migrates to digital forms of money, the infrastructure for cash, such as distribution networks, ATM machines, may deteriorate, and businesses may resist dealing with it. One approach may involve subsidizing the provision of cash in underserved areas. It is to be noted that digital currencies rely on technology and electricity. CDBC may not be a viable solution if access to technology and electricity is limited. If the problem is instead the supply of bank accounts, the question is whether the private sector can offer alternative solutions. M-Pesa in Kenya and Paytm in India are examples of successful initiatives. Alternatively, the government could facilitate the deployment of online banking and communication infrastructure in rural areas and reduce the cost of bank intermediated small value transactions by deploying fast payments. The landscape of digital currency is also evolving quite rapidly, with many types of digital currencies ranging from central bank digital currencies, which was backed by the central bank, stable coins introduced by technology firms, mobile money to fully private cryptocurrencies. Our panelists will help us navigate the digital currency landscape during today's webinar. Now it's time to turn to our speakers. I will now be inviting our speakers in turn to make their presentations. Each speaker has 15 minutes for the presentation. And our first speaker is Mr. John Kiff from the IMF. John, you have the floor for 15 minutes, please. Thank you.
Thanks, Bilal, and thanks for giving me the chance to share some of my views with the world here. Starting from the top, you'll see the picture of two. Start my video. Okay. Okay. Yes, you'll see. There's two images here.
John, if you could go into slideshow mode, that might. Yes, perfect. Thank you.
Okay, here we go. So you'll see two images here, and that represents basically the background to what I'm going to be talking about today. So first of all, it goes back to a 2018 paper that we published out of the IMF on central bank digital currency. We call it Casting Light on CBDC. I view this as kind of a 20,000 foot level paper. It talks about all the policy issues in design and issuing CBDC. After that, some of us got together and decided it'd be a good idea to get down into the weeds and talk about the nuts and bolts of CBDC. So the second paper there is something that we hope will be published within the next couple of weeks. You can never know because our communications department is prioritizing COVID-related papers, so we may get backed up behind that. Next slide. Yeah, this is the standard disclaimer, of course, that these are my views only and don't reflect necessarily those of the IMF or IMF policy. That's an important point to make here. This is, in fact, the second paper is a working paper, so it truly is something coming from the grassroots of the IMF. Next slide, please. Next slide. Now, I'm on a slow connection, so I may be not seeing things as soon as you are. So we've all heard of the BIS money flower, and some other authors at the IMF have money trees. This is our thing, the money matrix. So in this matrix, we try to determine basically map out the different types of digital and physical monies and by key characteristics. First of all, I just want, and this is going to be a bit repetitive on what Bilal said, but we have a very, very strict definition of CBDC. In fact, retail CBDC. It's widely accessible digital representation of a sovereign currency that is issued by and a liability of a jurisdiction, central bank, or monetary authority, and be legal tender. Those conditions all have to be met. So right away, I like to dispel the notion that, let's say, the Marshall Islands' infamous SOV currency would not classify as a central bank digital currency. First of all, it's not a digital representation of the Marshall Islands sovereign currency because the Marshall Islands sovereign currency happens to be the US dollar. And in fact, the Marshall Islands doesn't even have a central bank per se, and so it's not issued by central banks. It will be legal tender though, but it doesn't meet all those strict definitions. So the Venezuelan Petro, for instance, is another one that we would not classify as a CBDC. So for us, when the right to leftmost columns represent cash and retail CBDC, and of course they cash and CBDC share the characteristics of being central bank issued, legal tender. They're backed by the central bank. They're pegged to the local fiat currency, and they allow for peer-to-peer transactions. And then also the CBDC has the bonus of being potentially programmable using smart contracts. The next column over is what we call synthetic CBDC, and that's something that's being pushed by my boss, Tobias Adrian at the IMF. We published a fintech paper mid last year on the topic. So that's essentially a stable coin in which the reserve assets that back that stable coin are deposited at the central bank. So it's kind of like almost CBDC, but not quite. And a stable coin, for those that aren't in the usual stream here, I mean, they're basically crypto assets. So crypto assets being things like Ethereum and Bitcoin, but they're crypto assets that are pegged to fiat currencies, and most of the popular ones are also backed by that fiat currency. So something like the Circle USD, it's US dollar pegged, and it's backed by deposits at commercial banks, US dollar based commercial banks. You'll notice that I've kind of got shading on the optional shading on legal tender, and some have pushed back to me on that, saying no, a synthetic CBDC, that's privately issued. Bitcoin is privately issued. It's not even real money. So how can it be legal tender? But it could be legal tender, and I bring up the case. I think it's either Barbados or Bermuda who allow citizens to pay their taxes in some of the popular stable coins. So it is possible. So that's the map of the world for me. Next slide, please. Sorry, so I'm speaking of map. In fact, we come to the map next in the next slide. Now, I'm going to assume you can see it. My connection's slow, so I'm not seeing the map on my screen yet. But basically, what we've done is we extensively have surveyed the world for what we call CBDC explorers. And then this map basically summarizes the results of that. The paper will have actually a more detailed tabulation of these. And it's not based on any survey, private survey we did or anything. It's based on purely on public information. So there's 7 countries that we would call the serious explorers. And I'm not seeing the legend on this version of the map here, but those are the ones in blue. And those are the countries where we see pilots being conducted or proof of concepts. And there's 7 of those. So we have Uruguay, for instance, and Ecuador, who have already done pilots and are now, in fact, in case of Uruguay, they're still evaluating the pilot. Ecuador did the pilot and decided not to go ahead. And then there's the Bahamas, the Eastern Caribbean Central Bank, China. They're actually doing live pilots right now. And the Riksbank has done the proof of concept stage. Those are the most active explorers. The next group, the ones in orange, those are the ones where the countries are still in the exploratory stage, or they've done some exploration and decided to not put it on the shelf for a while and let them think about it a bit. And Canada, for instance, one time would have been in our sort of hot group, but they've now decided that they're still continuing to do CBDC research, but more on a conditional basis, so they're ready to go if necessary. And then there's the other colored group here, which I've lost track of the colors here, but the third one, those are ones that are unconfirmed explorers. So, those are the ones where all the first 2, the 7, the 29 in those first 2 groups, we have confirmation of all the information directly from the CBDC's, the central bank's website. The other ones are based on articles in reputable news sites, but we thought we should differentiate them, because it's possible that the news services got it wrong. But so that's the map of the world as we see it. So there's 46 altogether. There's also some others we know of from private information I can't include on here because we have the information on a confidential basis. So there's even 1 or 2 central banks that have already done pilots quite stealthily, but we don't have them on here. Next slide, please. And I'm going to assume that you're seeing the transition already. So in terms of the motivations being cited, this is particularly amongst the advanced market countries, a major motivation would be enhancing payment system competition. These are countries where the use of cash is declining quite dramatically, and in some cases, private sector payment systems are dominating the payment system. And for instance, in the case of Sweden, you have the Swish system, which has basically controlling something like 80 or 90% of all of the retail cash-like flows. And then in the case of China, you have WeChat Pay and Alipay that dominate there too. So the concern there is that there's going to be monopoly distortions resulting from that loss of use of reduced cash usage and heavy use of digital currencies. And we all know what happened, what the risks are with monopolies, basically, that there may be the private money issuers may not be internalizing the costs of systemic disruptions. They might be underinvesting in security, and monopolistic private money issuers could abuse their power by offering partial, inadequate, or expensive services, or take advantage of the data. The other important motivation would be supporting financial inclusion, which is the main topic of this discussion here. We've talked to a lot of the central banks about their financial inclusion and financial digitization motivations, and also a big factor that wraps up in that is the reducing the costs associated with producing physical cash. And for many, it's not just the cost of producing it, it's cost of managing and moving it. So in the case of the Eastern Caribbean Central Bank, the concern is basically with getting cash from the central bank to islands throughout the region, and they have very big security concerns around that. We sort of jokingly could talk about the Pirates of the Caribbean, but it's quite a real thing, and in the case of the ECCB. But I would add that one of the points of our paper is that issuing CBDC is a complex and possibly expensive proposition, and so you can't overplay that reduced cost too much, because the cost of producing physical cash, yeah, we know that there's heavy costs there, but there's heavy costs in issuing CBDC, including those bumping up cybersecurity in a very big way. And also, in most cases, most countries will continue to produce some physical cash, so the fixed costs are still there. Another motivation is improving monetary policy effectiveness. For instance, implementing targeted policy, and also tapping into the more granular payment data to feed into macroeconomic projections. And another way it can possibly improve effectiveness is if the currency is made interest bearing, which for some countries that are on the zero lower bound of their policy rates, the possibility of having negative interest rates is also interesting. But interestingly, most of the central banks that are seriously considering CBDC don't plan to make them interest bearing. In fact, they go out of their way to say it'll be zero. There will be no interest on it, because the fear is that if you put too high an interest rate on the CBDC, it might actually pull deposits out of the commercial banking system. So, i.e. disintermediation risk. So it's an interest in policy motivation, but not one that we're seeing in actual fact. And also, another motivation is to push back on the adoption of privately issued currencies, and of course that's really a placeholder for Libra concerns. And there's the fear that the private currencies like Libra might threaten monetary sovereignty and financial stability. And also, some are looking at it's kind of complementary to the last one, using CBDC to improve the traction of the local currency in order to reduce dollarization. And lastly, this is one that's coming up in some discussions in the US, using CBDC to more effectively distribute fiscal stimulus to unbanked and other recipients. Next slide, please. Just wait till it pops up there on my screen. Yeah, okay. It's coming on. Okay, yeah. So one of the risks is this is the other side of we talked about how it might make monetary policy more effective, but it could also affect the transmission of monetary policy in ways that we don't anticipate. But the paper, that 2018 paper, argues that the impact is likely to be it's likely insignificant under plausible CBD designs, and that's a really important issue, that the CBDC needs to be designed with some of these risks in mind. And in fact, monetary policy transmission could strengthen if the thing is interest bearing. You can use the interest rate on the CBDC as a policy tool. Also, we talked about this earlier. There's the risk of banking disintermediation, and in a lot of developing countries, this first option to deal with disintermediation is not really very plausible, because they don't have the wholesale funding markets that advanced countries have. But there's been several suggestions that have been put forward to control potential disintermediation, including putting holding or transaction limits on, or restricting the ways that you convert into CBDC. Obviously, going from physical cash into CBDC is not an issue, but there are ways of restricting the conversion of commercial bank deposits into CBDC. Also, the CBDC could increase run risk, because it basically offers a speedy way of moving out of commercial banks into CBDC. That is definitely a risk, but in most countries already, it's pretty easy to go from a bank account, one bank to another, with a push of a button on a mobile device or whatever. So our sense is that's not really a big risk. And also, there's the dollarization risk that we effectively talked about in the last slide when we were talking about Libra and so on. The other problem is that, say, a US dollar CBDC readily available could be in those countries could lead to dollarization. So there's all kinds of different key design principles and questions that have to be discussed. And one of the biggies, I think, is this single versus multi-tier So, when academics think about CBDC, they think of something that's issued and run totally by the central bank. No one's thinking about that. The way they would likely be run is on a multi-tier basis, where the central bank issues the CBDC, but leaves the run-in of the CBDC to the private sector. So in the case of China, they're allowing Alipay and WeChat Pay to actually run the customer-facing parts of the operation. Then another big question is whether you're going to use DLT technology or you're going to use a more centralized database. And in fact, in the 7 pilots and POCs that we're seeing, most of them, in fact, they're using distributed ledger technology. But interestingly, the Uruguayan pilot did not. It used a conventional standard database. And then there's the trade-off of anonymity and privacy concerns that feed into the design decision, and we may get a chance to talk about that in the Q&As. And then availability and limitations and how you handle offline access. These are all critical things that all the central banks that are piloting and thinking about CBDC are wrestling with, whether it be interest-bearing, we talked about that before, and also whether to embed smart contracts and programmability. There's fascinating things that come out of that thought process. But one of the things that we like to pound home is the design principles, these ones we're talking about on this page, should be independent of a specific technology. So whether it be DLT or non-DLT, things like whether it has multiple tiers or not, and things like design and anonymity and privacy trade-offs, these are things you have to think about before you start thinking about, should I be using a DLT-based system or traditional one. And of course, you need to build in design flexibility for changes or evolutions in technology. And possibly we should be looking at ways of standardizing to some degree the global landscape of CBDC to allow for interoperability at some point in the future. Next slide. And this just lays out the picture of multi-tier versus single tier. And the last row is that synthetic CBDC I mentioned. So that really just illustrates the point that I was making earlier about the operating models being single or multi-tier. That first row is almost like a straw man. No central bank that we know of is doing that. I can only think that it'd be applicable to a country where there's really no private sector to partner with in the run-in of the CBDC system. Next slide. And I'm probably running out of time here, so I'm not really going to get into this, but this just lays out all the different complications that has to be thought through: legal issues, regulatory issues, internal organization, the need for the board and operational level staff to understand all the risks. And even if they outsource some key activities, it doesn't mean you're outsourcing responsibility for those risks. So even the synthetic CBDC approach is not going to allow you to abdicate responsibilities for the CBDC, especially since the common person will think they hold a synthetic CBDC in their hands or whatever. They will still think of it as something that goes back to the central bank, so that you can't keep their hands off completely. Next slide. I think it's the last slide. Which I'm not seeing yet in my slow connection. What does that, am I the only one not seeing the next slide? Oh, no, okay, that's it, that's the end. All right, well, thank you for your attention, and maybe we'll get to some other interesting issues in the Q&As.
Thank you very much, John. Really clear, crisp, clear. It's as clear as your 2018 paper. When I first started trying to understand the space, I read your paper, the one from 2018. It was really providing the lay of the land for CDBC, all the issues and so on. And today, listening to your presentation, it's even crisper, very simple to understand. You provide us with the definitions, the motivation for issuing the currency, the risks of issuing the currency, the design principle and options that one might consider, the models and the tiers and the legal and regulatory or governance questions and aspects. So thank you very much. We'll come back with some more questions later on, and also encourage all of our participants, I think now we're about 230 or so, to type your questions. Some of them are already typing questions, so you might want to take a look, John and other panelists. Now I'd like to invite Mr. Faragalla from the World Bank to provide us with your presentation. The floor is yours for 15 minutes, Mr.
Thanks, Bilal. Thank you for inviting me to this important session. And let's first slide, please. Actually, the issue of CBDC and it's part of the definition of money in general. Money actually should fulfill specific functions like being a medium of exchange, being a unit of account, and being a store of value. The CBDC at the end is a sort of money that at the end issued by the central bank. So we have a sort of qualifying characteristics for the CBDC, including that it should be a central bank liability, it should be denominated in an existing unit of account, it serves as a medium of exchange and a store of value, and finally it is exchangeable at par. We will actually at this stage we need to differentiate between two important definitions: the CBDC as a currency or a money, and the payment system that is enabling the exchange of the CBDC. And typically we will refer to it as CBDC payment system or CBDC arrangements or sometimes CBDC infrastructure. But we are talking about two different issues here. The currency is different than the payment system that is enabling the exchange. So looking at the design elements of the CBDC and its infrastructure, we have to look at different issues. First, of course, CBDC should be digital, but looking at the cash, because it's the most, I have to say, the nearest form of the CBDC as being issued by the central bank. The cash is anonymous. The cash is the transaction is not traceable. It's a peer-to-peer transaction, and it's interest-free. So those are possibly the things that the people, whenever they are having something new like a CBDC, will compare to. So they will definitely compare to cash. However, we have other form of central bank digital currency, which is the CBDC, the central bank deposits. The central bank deposits are typically exchangeable only among financial institutions at the central bank. And the problem here is that they are not available on a 24/7. However, there is, so here we have a different characteristic. Let's have a look on the difference between a token-based and an account-based infrastructure, because this is, I think, one of the very arguable issues, and we were having an interesting discussion just 1 hour ago about this point. From architectural or from design perspective, there is a big difference here, where if we are talking about an account, then the database or the architecture of the data, it has the account as the main object. The account itself is having balance, and the account is having or assigned an owner. So this owner is having full access to this account. On a token-based system, the unit in the system is the token. And let's maybe have a look on the token. Tokens typically like the coins, like the bills, like even in gambling, the tokens that are used in gambling. So those are the points or the subject that we are talking about. In a token-based system, the unit is the token. And the token itself, especially if we are talking about a digital token, so the token itself will have its own properties. And part of those properties will be the keys, where if someone is having those keys or those secrets or those, I have to say, values, he can access the token and he can change the ownership of the token. So This is a very, I have to say, structural or architectural difference between the tokens and the coins. But there are actually other differences. The BIS early identified a major difference when related to the form of verification. So let's see a transaction that is happening at the supermarket where I'm trying to give the merchant in the supermarket some coins, which are tokens in reality. The merchant in reality, he will not be concerned of me. I mean, he doesn't care who is paying the money. He is concerned only that the money is valid and the money is not counterfeited. So this is how typically you look at the token. So whenever you are having a digital token, the concern is that the token itself is not counterfeited, is not electronically counterfeited. So the check is on the token itself. The recipient of the token is checking on the token itself. It's not checking on the person who is paying or transferring the token. The other difference here, if we are paying by card, the person typically checks my identity. So at the merchant level, he looks at the card. He ensures that I'm having the ownership. I'm having the right to use the card. So in this case, the check is on the identity. This in reality brings an important third difference, which is that in any account-based system, there should be a third party, there should be an institution, typically a financial institution, that ensures the effectuate of the transfer. So it needs somehow some third party to manage the authentication, some third party to make the credit and the debit. The issue with token based is that if we are talking about money, it doesn't need such third party because it's decentralized. I can make a transfer by cash and bills directly anywhere. However, if we are talking again about a digital token, this is in reality at the end it will need some sort of third party that will enforce the transaction. However, so those are typically the three differences when we are talking about a token-based versus account-based system. The third part here is related to being a wholesale versus a general system, a general purpose or retail system. We have two differences actually. We have either a system that is only between infrastructure, CBDC infrastructure that's only between or accessible to central bank and some of the financial institutions. This is typically a wholesale one. Or we can have a sort of a retail system that is accessible by public, so individuals and institutions are having access to the CBDC. The first wholesale one is to a great extent, it will be similar to the RTGS. However, it will have maybe different functions. Most probably, it will extend the accessibility to the central bank money. So possibly the participants will include other institutions other than the financial institutions or other than the typical financial institutions. It could include, for example, some other distributed ledgers. It include maybe some other stable coin arrangements, maybe the treasury of the country, maybe foreign financial institutions. So here we have a different structure possibly that will be enabled. At the same time, the system most probably will be operating on 24/7, 7 days a week. So this is a different, I have to say, from the typical RTGS and general ledger systems. For the retail one, I think we have multiple models. John talked about them, and if I have time, I can talk more. But about other models. But the issue here is that if you are thinking of a system where everyone is having access to the same system, individuals, merchants, corporates, plus financial institutions. And all the transfer are done on peer-to-peer basis, and it's on central bank money. That's a big difference. That's a major difference. And it's a really big shift when it comes to financial or payment systems. The fourth point is about being anonymous or pseudonymous versus KYC. This aspect, I think, is very important. If you want a simulation to the cash and coins, then you need to provide an anonymous system. A lot of actually systems have been, or I have to say, thoughts have been done on this, noting that, for example, the CBDC is traceable even if it's anonymous. There are some design aspects where, for example, the system could be anonymous to a certain extent, and then beyond this level or beyond this threshold, the person has to inform about himself. Other design aspects are, for example, differentiating or separating between the account and the account holder information. So if you have the transactions are transferred without maybe details about the account holder, however, there is information, full information about the account holder in another place or registrar where we can refer to it upon request. So it actually, the discussion is going beyond being anonymous and it's touch basing on other aspects related to privacy and different aspects of privacy and data sharing. Being interest or interest-free, interest-bearing or interest-free, I think it's a very important point. Again, if you have, and this is mostly on the monetary policy aspects, to what extent the central bank wants the CBDC to be attractive to the people. If it is interest-free, then it could be less attractive. If it is having the same interest rate like other commercial bank deposit, then it will may lead to bank runs. And in this case, the monetary policy in the central bank has to manage not only being interest or interest-free, but as well the level of the enumeration or the interest rate. We have other aspects like the database, the blockchain, the central ledger versus the distributed ledger. I think the interesting part related to the DLT is that it was having some concerns like the speed of processing, like the probabilistic finality, like, for example, the data sharing of the ledger. Those were aspects actually addressed in the new technologies of the DLT. We have models of the DLT where, for example, the data is controlled in a way for the sharing. We have technologies where there is a sort of finality based on a solution based on a notary node to overcome the probabilistic issue. We have technology that is enabling the delivery versus payment or payment versus payment, like technologies like the cross-chain atomic swaps. So the technology actually is evolving when it comes to the DLT. And I think many of the problems that we were facing in previous versions are under resolving right now. Next slide, please. And the next one as well. We can jump this one. Next one, please. If we are talking about a model for a wholesale system, most probably a wholesale system in this case will be just if it is an alternate. No, the previous one. It will be an alternate to the RTGS. I don't think it will be an alternative, but it will be something like another system that is part of the larger national payment system. the system here will enable possibly some sort of expanded access. It will possibly maybe for me it makes no sense to make it an account based, or to make it the typical structure of an RTGS, because it will be another RTGS. So to great extent it needs to follow a sort of token based structure. It needs to follow some sort of distributed ledger in order to actually provide a difference than the typical systems, and hence provide some sort of other features than the typical system. Actually the very big promise of the DLT is that it could provide some sort of savings in the reconciliation, and this is something is not I have to say practically not tested. But it's still something that among financial institutions, this is one of the biggest saves that the DLT can provide. If we are talking about a general purpose system, possibly it could be token based, it could be account based. Here we are having a model where everyone is having direct access to the money at the central bank. At this stage, actually, I need to say that there are a lot of functions that the retail CBDC arrangements or infrastructure should provide. It's not only about the issuing and redemption of the CBDC. Of course, this is a major requirement. But other aspects related to, for example, the KYC and enrollment of users, aspects related to the management of the user accounts, the management of the relationship with the users, providing the user interface, possibly operating the core infrastructure, of course, licensing the service providers. We have actually a lot of function that should be provided, and here the model here, whether it is a direct model where the central bank is directly interfacing to the end users, or the next slide where the central bank is intermediating some of the providers like commercial banks or other service providers. It's a level of these centralization or decentralization. It's the level of distributing the function that should be provided by the whole system or the whole arrangements among the central bank versus the other commercial banks and the service providers. So it's we are still investigating a couple of models. Actually, we saw models initiated by the ESC-CB, models initiated by the Bank of England and Bank of Canada, where we have different level of intermediation, different level of decentralization of the system. I know the time is running out, so possibly I will go to the final slide related to the financial inclusion. You can just jump 2 slides. Next slide, please. Actually, the CBDC could provide a way for universal access to a digital means of payment. That's a statement that possibly needs some sort of testing and needs some sort of review. So theoretically, the CBDC, if it can provide a helicopter access from the government or from the central bank directly to individuals, where they can push directly, for example, in a case like the COVID-19 or any other pandemic, they can push directly payments to individuals. But in the reality, you have a lot of issues here. First, what are the actual gaps right now in the market that the CBDC can fill? What are the failures in the retail payments provider that the central bank can actually cover? Is there, for example, a trust issue with the commercial bank money? I don't see this as a major issue here, but the CBDC would provide more trust, but would this be a resolution to the problem? There could be, for example, there should be a sort of a cost-benefit analysis to the value of the CBDC and the benefit to achieve a sort of a financial inclusion. Research actually could try to better understand the behaviors of the different segments of the customers' behavior of the, or maybe the existing solutions of the payment systems and why they have failed. So this could be a real differentiator when we are addressing the aspects of financial inclusion when it comes to its relation to the CBDC. Thank you so much for allowing me to provide the presentation. Thank you. Back to you, Bilal.
Mr. Ahmed Faragallah from the World Bank Group, thank you very much for really drilling down on the design elements. What John called in his presentation, very quickly, he touched on the design principles or options, but you gave us a very good drill down on the various options and the trade-offs and the considerations in that design. So thank you very much for that, especially the explaining of the token-based versus account-based CDBCs. Now I'd like to move to our next speaker, Rafael Auer. You have 15 minutes, please.
Thank you, Bilal, and ITU. Very honored to speak here today. Let me share my screen. So whereas we had nice introductions on general CBDC frameworks, I'm going to be speaking spot on how we can make them inclusive. As always, I'm going to be speaking on my own views and not behalf of the BS. So we've talked about one development that the pandemic has put to the fore, and that is the declining use of cash, and the shift to digital payments. But another development is that payment systems have also featured prominently in government-to-person payouts. And these two developments, going forward, if you want to tackle them with the CBDC design, there are conflicting goals in there, in that to offer a digital complement to cash requires having low access hurdle. But for other long-term goals, such as offering transaction accounts that may be a bridge to saving accounts, or having payment systems that can also be used for social goals, such as government-to-person payouts, you want to have good identification to eliminate fraud and do good KYC. So retail CBDC designs that sort of want to focus on the social dimension need to balance these long-term and short-term goals. And in this, I'm going to be arguing that the access framework is key, and the operational architecture, how the public and the private sector work together, and the possibilities that this opens for the public sector to address social goals are key. And I'm going to be drawing on sort of a rich set of work that we've been churning out at the BS. We've worked on COVID cash and the future of payments. We've worked on the technology of retail central bank digital currency. And actually, we have a forthcoming piece on inclusive payments for the post-pandemic world. And yesterday, we released our annual economic report special chapter on central banks and payments in the digital area. So we all know that cash use is declining. We've probably used it much less in recent months or weeks than that used to be the case. And what is really right on the left-hand panel, I'm showing Google search interest over time on searches related to virus and cash transmission. And then we see just how outstanding the recent period is. We've seen bouts of flus, of MERS, SARS, and so forth, but the pandemic is completely unprecedented in terms of the concerns it gave rise to about whether cash can transmit disease. And so payments have digitized, and what we know is payments are basically behaviors, right? There are generational aspects, and behaviors persist. So the important thing is not that we will have different payment patterns for a few months or maybe a year, but what we will see very likely is a persistent change in how people pay. And the problem that this poses, and you can already see in some jurisdictions such as Sweden, that there are then instances where you cannot pay. You cannot pay for online transactions with cash, and more restaurants and other services in Sweden only accept payments by card. And that raises inclusion issues in advanced, but certainly also in emerging and developing economies. Let me put a little insert here, right? These are not developments that central banks want or that they're driving. They just need to react to it. And actually, one important element of central banks' responses is not the development of CBDC straight out, but it's also to strengthen the trust in cash and universal acceptance. So here we're just showing the number of measures that central banks have taken around the globe to sterilize banknotes, to communicate that they actually don't transmit disease, and also to just urge merchants to continue accepting them. But still, in all likelihood, these concerns are very, they feature broadly on consumers' minds, and changes in payment behavior are likely to persist. Another development is that government-to-person payments have become important as a response during the pandemic, both to address social problems and to restart the economy after this big shock. And in this, in the left-hand panel, we just list a number of measures. A lot of programs were actually simple cash-based transfers. If we look on the right-hand panel, we see that sort of the mostly used means to disburse cash was a credit transfer. But at the same time, there was a large spectrum of payment means used, such as banknotes, checks, mobile money, prepaid cards, or e-vouchers. And all of these have made certain problems in payment system evident. I think, for example, in the US, yesterday, a report was published that 1.1 million checks have been sent to deceased people because the identification system wasn't updated. So payment system and the ability to reach, to pump money where it is needed, where it can kickstart the economy, has become an important feature during this shock. Let us now view the inclusive dimension of retail CBDC designs from these goals. On the one hand, we need to offer a digital complement to cash that is accessible. And so obviously access is easy if the identification requirements are low. On the other hand, we also have long-term objectives, such as offering transaction accounts that may also be bridged to saving accounts. And we want to tackle fraud and government-to-person payments, and that certainly requires high identification. And this highlights two dimensions of CBDC designs. First, the access framework that has been mentioned before. I'm just going to briefly go through it again. So do you want to tie access to strong identification, or do you want to allow for just knowledge-based identification? The other side is the CBDC architecture, the role of the public and the private sector, and because in the end, a CBDC, in some sense, from an inclusion perspective, is tackling market failures. Otherwise, you would leave that to the private sector. So you need to ask yourself, well, I want to tackle market failures. What is my operational capability to do that? And CBDCs are not created equal. Different designs give the central bank or the public sector very different possibilities. Let's look at these in turns. I'm just going to repeat what Ahmed has said very nicely before, right? The importance, when we speak about token or account-based access, it's a conceptual difference. It's not really related to the technology per se, because also your smartphone application for your bank account will use a lot of cryptography. What it is, if you initiate a bank transfer, the question that the bank that executes that payment asks before it does so is the person that claims to own the account actually behind the payment instruction I'm receiving, so it verifies your identity. In a token-based system, the legal system is such that the question is not, I receive a payment instruction, is it coming from the right person? You just ask, is the payment instruction the right thing? Just as if you had a banknote, somebody gave it to you, you wouldn't really be concerned about who gave it to you. You would be concerned about how good is the banknote. So that's the conceptual difference. And the consequence is, with a token-based system, we can have things like physical devices, value-based CBDC devices, a prepaid card that you can get somewhere else, that you can transfer in an offline transaction, and it still holds its value, and it then can use maybe for an online transaction. And obviously that could have a system like this, could have a very low access hurdle. People that mostly use cash could complement them with prepaid value cards in their physical wallets. And if they run into a situation where their cash is no longer used, they can then use these physical value cards. Yet at the same time, we have these long-term objectives. We want to increase financial inclusion also by offering access to transaction accounts that also, maybe even if the CBDC only can be used for transactions, that generates an identifier that the private sector then can connect to a saving account. And we want to have public sector means such as disbursements of government to prison payouts, where we need strong identification. And obviously, a straightforward solution is that we could have mixed systems. And actually, ECB has made a very interesting proposal. They did it more in the context of offering privacy, which is very important, but I think it also has an inclusion dimension where you have low value transactions on a token-based basis without requiring identification, and then you have higher value transactions on an account-based basis based on strong identification. So that is the first dimension. But there is another dimension, and that is that when we think about CBDC, as John said before, CBDC are not created equal. There are very different architectures on how the public and the private sector work together. We can roughly classify them in three. One is direct CBDC, so that's really the central bank operates the payment system. In another one, CBDC might be a cash-like claim on the central bank, but the central bank sources all operations out. And we can think about mixed hybrid systems where the private sector operates the vast majority of payments and the central bank acts as a backup and maybe conducts some payments in line with social goals. So let's take a bit of a deeper look here. Let's first look at the polar options, the direct and the intermediate CBDC architectures. So in the direct one, it's not that the private sector doesn't have any role, right? It could still provide the ultimate user interface. So your smartphone, your operating system would have the interface that would be provided by the private sector. And the private sector could also conduct the KYC AML. But the central bank operates all retail accounts in real time. So if you push in a payment instruction, it has to reach the central bank server, and then the confirmation has to reach you. Obviously, the important thing here is that because the central bank operates retail accounts, right? It has a list of all the accounts in the economy and who owns which funds. It can operate payments in line with social goals, right? It could, for example, here determine that C is not served well by the private sector, so the central bank will offer the special account. But the question that you obviously have to ask yourself is, how well suited is the central bank for such an activity that requires a lot of interaction with the consumer, activities that we normally think are better suited to be handled by the private sector. So thus, the other option is a fully intermediated one, in which the central bank only operates wholesale accounts, just as in today's system. The difference being that the CBDC that consumers and merchants hold are still direct claims on the central banks, and the payment service providers just sort of keep the record, but they don't have them on their balance sheet. The problem is, when we think from an inclusion dimension, is that the central bank, how can it address market failures in such an architecture when it doesn't even know retail balances, right? It's a system that is just as today in terms of who does what and what the operational capability of the central bank is, and though it's likely to be subject to the exact same market failures like today's system. So that is why we also consider a third option, a system where still the vast majority of payments are handled by private sector intermediaries, but the central bank acts as a backstop. And what it does, it retains a copy of the retail balances. So it technically, it has the information needed to restore clients. That is first, it's a resilience consideration in that the central bank, if one intermediary fails, the central bank can take the retail relationships and transfer them to a working intermediary. And second, if we think about social goals and payments, because the central bank knows retail balances, it can also operate some payments directly. And with that, I want to conclude. So we have these underlying trade-offs for CBDC design. We want low access hurdles, but good identification. We need to think about the access framework, and we need to think about the architecture and the possibilities it gives to the central bank. We want to differentiate, we want to address short-term goals, such as providing a digital complement to cash, and long-run issues, such as fostering financial inclusion generally. And again, this is, only a sub-dimension of a need for a holistic design of all technology choices that we line out in a BIS quarterly review articles titled The Technology of Retail Central Bank Digital Currencies. With that, I want to conclude and give the word back to Bilal. Thank you very much.
Rafael Auer of the Bank of International Settlements, thank you very much for a very clear, concise presentation. I retain a quote from your presentation where you say COVID-19 causes a persistent change in how people pay. You showed us the numbers and how the change happened, and you predict that that there will be a persistent change. That's definitely something that I would agree with personally, and we see it in our daily lives. Thank you very much for a clear presentation, also on the trade-offs and considerations for a central bank digital currency. Our next speaker is Klaus Lober of the European Central Bank. Klaus, the floor is yours for 15 minutes, please.
Thank you very much indeed, and hello to everybody. It's a pleasure to join you. I'm well aware about the advanced times, so given that we already had 3 very rich presentations and have heard a lot of detail, let me, rather than giving you a full presentation, just highlight and perhaps act as a commentary on some of the key aspects. Because if you look at innovations in the field of currency, central bank digital currency, and the impact on financial inclusion, it may be good to first remind us that this is part of a wider trend. It's not an isolated focus, but there is a genuine demand by users for improvements in payments. It is based on a desire to have fast execution and enhanced convenience. This is availability of services 24/7, immediate execution. It's broader access, which very clearly ties into the discussions we have around financial inclusion. How can you make sure that a wide range of financial or economic agents actually has access to payment mechanisms that are being offered? It's an adaptation to innovation to the extent that there is new potential offered, for example, by tokenization and by distributed ledger technologies. How can you make sure that also the payment, the money aspect of economic transactions can profit from those technological developments? And lastly, of course, there is a wide issue of enhancing the efficiency in cross-border transactions. Again, something, if you look at migrant workers, this is something which has a clear potential to enhance access and reachability across the globe. So a bit picking up on what Rafael said, we are actually in an intriguing situation nowadays because we are probably in a perfect storm. We had a bit of the initial push, which was caused by private sector developments, by the crypto coins of this world. And of course, given the inherent instability of cryptos, the push was to see how can you actually migrate the potential that is in these innovations into the traditional trusted payment sphere. And of course, this includes in many instances a turn to the central bank to see what role could the central bank play here, given that central banks rightly are cautious creatures and have been reflecting deeply about what could be done and what is the role of a central bank and how could actually innovation be done in a safe and efficient manner. They have not acted quickly, and in the meantime, the private sector has stepped in to come up with solutions mirroring the desire for safety and stability through private sector solutions. So again, as I said, I will not focus on repeating what has been said before about the details. But one aspect for me that I want to emphasize, which was said very clearly by John, CBDC, central bank digital currency, has, as the name implies, a very strong relation to a central bank. It is a liability of a central bank. And given that anybody, including private individuals, want to have controls over their liabilities, what goes hand in hand with this is if you have potential to create liabilities for the central banks, you want to control it. So central banks, of course, take a very close look at who can actually become the holder of a liability against the central bank. What is important to recall is, and that was laid out very clearly by the previous presentations, there's a wide variety of design features about how you can structure central bank digital currency. And as it was mentioned, this is a reflection of the different motivations. If you want to substitute cash, you're looking for a product which is available 24/7 to everybody on a basis where probably you don't care about interest bearing. If you're looking more at a product that is to enhance the efficiency of the wholesale financial markets, you're looking at different features. You're looking at limited access. You're looking probably at more a interest bearing structure. Again, it really depends on what your motivations are. The result is that probably depending on the particular situation in every jurisdiction and the particular concerns of a central bank, there is no such thing as the central bank digital currency. Each emanation may look quite different from each other. And again, that is a very practical issue when it comes to having harmonization, standardization, about making clear to the public, to the citizens, about what it is that you're offering here, because they may get misleading information from another country, from international developments, and you need to communicate very clearly here about what you intend to address and what you intend to solve. At the same time, having potentially quite different solutions immediately begs the question on what does it mean in particular when it comes to a cross-border usage? What do you actually plan here for foreigners who want to come to your country? Can they access the central bank digital currency? Can they hold it? Can they actually execute transactions in your CBDC abroad? These are very practical, very relevant questions that need to be considered. And again, currently in a commercial bank money world, we have established mechanisms how you transfer money across the borders, how you convert through FX mechanisms from one currency in the other. How would you do this in a digital currency world with potentially very different features, design elements involved? As to the implications, again, and here I would just like to subscribe to what Raphael said. There are quite a number of elements which are still not fully explored, less so on the operational aspects where we have now clarity, less so on financial stability and monetary policy implications where there is a lot of literature and a lot of central banks have looked deeply into this. But there are some aspects which probably deserve still a bit more reflections, like the legal considerations, not just the right of a central bank to issue a CBDC, but also about what actually is a digital currency. Can you use it to extinguish an obligation, which is the basic feature of money? When is the transaction final? How do you hold it legally? Again, we are talking ultimately here about something which relates very closely to the trust in the central bank. If there is a design flaw, or if there are legal uncertainties, the trust in the currency may be impaired. And again, the central bank is very well advised to take a very close look about these particular aspects. And the other aspect that relates to the point of Raphael of having general access directly to the central bank. Of course, this may facilitate some issues. And in terms of technology, I think nowadays there would not be a limitation for a central bank to actually offer directly holdings of CBDC to individuals. However, there are other implications, and some very fundamental ones relate to privacy. Privacy may not be so much a concern if you look at it from money laundering perspectives, but in many jurisdictions, privacy, anonymity are a basic human right. How would a central bank handle the potential wealth of information on the economic activities of every citizen? These are questions that need a very careful consideration and that need to be looked at very clearly. These are just a few highlights. Again, I'm cautious about the time, and I will actually skip a comparison to the private sector solutions. But the one point perhaps that I can't help noticing is, again, in the private sector, you have a wide variety of projects, of propositions, ranging from projects that target only the sophisticated financial players to solutions that are actually aiming to replace traditional currencies, or at least traditional mechanisms to execute payments. The focus on a hybrid model is also very much underpinning the proposition of Libra, having a centralized element where somebody issues a new form of means of payment, but you leave it to decentralized economic agents, wallet providers, to make the new means of payment available to every citizen and to facilitate the holding and transfer. So again, some of the underlying issues are very similar, whether you look at it from a public or private sector perspective. The last 2 points that I want to focus on to give us a bit of time for discussions. One point I want to flag is the trade-offs. Of course, you can look at a new established payment mechanism like central bank digital currency, but how does it interact with traditional means of payments? How does it integrate? Again, the worst thing from a central bank perspective that you could achieve is having fragmented solutions which do not interoperate, which creates pockets in the economy that do not allow conversion between the different means of payments. And also, of course, you may already have well-working mechanisms, even if they have limitations in terms of reach of financial inclusion. What is important is you need to think about the cross implications, the trade-offs, and how to ensure interconnectivity. And on this side, there's a lot that is proposed to be achieved with the digital currency, a central bank digital currency, which from a user perspective, including from an individual's perspective, can be achieved similar by solutions like instant payments. So again, it is worth to take a very close look about what may the benefits and disadvantages of each individual approach, and do you choose just one, or do you support multiple solutions that interoperate? The last point that I want to flag with you is the cross-border dimension, because here there's probably an area where there is certainly a higher degree of potential for new solutions, given that the existing mechanisms for cross-border payments are slow, opaque, costly, and not always overly efficient. In the retail domain that we are looking at for the financial inclusion part, of course, the current models mostly rely on remittances, to a lower degree on card payments. Again, there is potential to see whether new solutions offered by new market entrants, or potentially also by central banks, considering on how they could actually connect domestic solutions to achieve a cross-border payment mechanism, could help to support and enhance the current ecosystem. And as was mentioned by a couple of speakers, probably if you look at the current considerations, in particular of those central banks who are a bit more advanced in their reflections, one mechanism to look at is the combined tiered or hybrid model. There's a lot of confusion about the terminology, where a central bank stands at the center and issues, but issues only to financial intermediaries who then would undertake both the task to make a digital currency available to end users and potentially connect both domestically and cross-border. And with these reflections, Bilal, I stop. I could have gone on for twice the time, but I think we should take the time to have a bit of Q&A.
Klaus Lober of the European Central Bank, thank you very much for being concise and also for really giving your perspective on the CDBC from your experience. It's very enriching to really look at the topic from various different angles, from the IMF, the World Bank, the BIS, and from your perspective from the European Central Bank. Now I would like to move into the questions and answer session. First of all, I have a few questions for you. I encourage the participants to type their questions on the Q&A chat at the bottom of the screen. We already see some questions coming in, and I see that some panelists have already started answering them. My first question is to John. How are the central bank digital currency pilots managing the trade-off between privacy of CDBC transactions and meeting the financial integrity AML CFT requirements? Over to you, John.
That's a great question, and I see it popping up in different variations in the Q&As also. That's one of the thorny trade-offs in the CBDC world. And I think one of the things was Hassan who commented that if CBDC is not made completely anonymous, it won't get much traction as a cash substitute. But central banks have to keep in mind that the FATF financial integrity standards, which require, in fact, in most cases, pretty stringent KYC, for instance. But the way some of the pilots are dealing with this, it varies. For instance, in the case of the Uruguay pilot, what they decided to do is, in fact, that one is fully KYC'd, but the rule is that they use a multi-tier model. So it's the private financial institutions run the ledgers basically, but the central bank doesn't have access to the detail in those ledgers. It's all anonymized. They keep the transaction file and the identity file separately. And the only time that the central bank can access those files, bring them together, is when they get a court order, and that court order to get that court order, they have to basically make a really strong case that they based on network activity, they have suspicions of wrongdoing. The other way to go, and this is the Bahamas Sand Dollar project. I think it's something. I think it was Raphael mentioned one of the ways that kind of framework where you have a multi-tier framework, multi-tiers of limits, so that for very small transactions, peer-to-peer transactions with very light, if not almost non-existent KYC can be used. I think there's light KYC in their case at the point where you get your device, or you load the money onto your wallet, but you're very restricted in how much you can actually do on it. But then they have a layered thing where at the very high level with full KYC, stringent observation of FATF standards and so on, the transaction amounts are higher. Those are the two main groupings I see in relating to that thorny trade-off.
Mm-hmm. Thank you very much, John. Next question is to Raphael. What are the design challenges towards deploying successful and inclusive CDBCs?
Thank you very much. That's very interesting. I think John already mentioned it, right? A lot of people, and actually that was the case also in central banks, were really concerned. If you launch a CBDC, isn't that going to disintermediate banks? But there's another diametral question, and it's how do you actually design it well so that it finds adoption? Because obviously you can only achieve your goals if you design it well so that it actually finds adoption among consumers. And I think the main aspect here is sort of that you need to have a strategy of like, why are you actually launching it and what will convince the consumer to adopt it, and you need to think about sort of the consumer needs first. And so that is they want a digital equivalent to cash that they can transact in a peer-to-peer manner. They still want the convenience of private sector payment options. They want an infrastructure that they can rely on, that is not prone to outages, because that's exactly where a CBDC would be handy, right? They want something that you can access ideally as easy as banknotes, and we should keep in mind, right, that central banks put a great deal of effort into making them both safe and accessible. For example, many jurisdictions, including the euro area, and banknotes actually have features for the blinds and so forth. At the same time, you also want to offer privacy. CBDC generally run on some form of record keeping, and you need to sort of deal with that information. And last, what Klaus talked about, it's not only about who can use it, but also where can you use it. Can I use it if I only transact in CBDC? Can I buy online in a foreign shop? If I go abroad, can I still use it? So what is the cross-border usability of the CBDC? So these are the consumer needs. And then on the other side, you need to think about how do these consumer needs translate into technical design choices. The first choice, that's what I talked about, is sort of this operational architecture. How resilient is it? What is the role of the private and the public sector? Once you know that, then you can turn to sort of the infrastructure that you run. Certain infrastructures will be very comparable to what central banks run today. If the CBDC only has wholesale records for the central bank, then it's just like today's system. On the other side, if it does feature retail accounts operated by the central bank, it's a whole different server infrastructure. Then we go to how we know what the product is, how can you access it? We go back to the token access or mixed system question that we just discussed. And last, we need to think about if we want to allow for cross-border interlinkages, how do they work? Do they work as in today's system, where the linkages work through the wholesale system that then connect via central banks? Or do we allow for cash-like retail interlinkages, where I can sort of, as a consumer, hold multiple currencies, multiple CBDC in my wallet? And all of these features, right, there are underlying technological trade-offs. You can't have it all. You need to sort of have a holistic package. And once sort of you've created this, like a well-designed CBDC that finds broad adoption, then you can sort of give specific prominence to the inclusion designs, such as operating some special accounts for unbanked consumers.
Great, thank you very much. Klaus, maybe building on that question and answer, where do you see the place for CBDC in the wider payment ecosystem, domestic and cross-border?
Yeah, that is basically the question that central banks need to ask at the origin of their reflections. And the answer probably will depend on how the structure and how the state of their domestic ecosystem is. Does it already have a sophisticated RTGS system at its backbone? Does it have major players who serve wide parts of the needs of the population? Are there banks available locally or not? Depending on the answers of this, the role of the central bank may be quite different. But irrespective of this, and that is going forward with the increased digitization that we have, and I think, again, Raphael rightly pointed out, COVID-19 is a game changer here. It's pushing for digitization in a way that we would not have thought possible about half a year ago. The central banks also need to think carefully about how will they stay relevant. And currently, they are relevant and visible to every citizen by banknotes. In the future, do they really want to rely exclusively on private sector intermediation? I'm asking it as an open-ended question, but that may have a trigger for some reflection in this regard. You can do a lot by integrating CBDC in the existing ecosystem. The hybrid models that have been mentioned are a key aspect here. And again, this will ultimately not change the fabrics of the financial system a lot. But if you really need to think about a replacement for cash and to make the ultimate safe settlement asset available to every citizen, then we are talking about something different. And here, I think that will be the most interesting questions going forward. Great.
Thank you very much, Klaus. Final question to the panelists before we move to the audience Q&A is to Mr. Ahmed Faragalla. what can the DLT, distributed ledger technology, add to a wholesale or retail CDBC arrangement?
Thanks, Bilal, for the question. I think it's very interesting. The issue here, in principle, the design should be independent of the technology. So it shouldn't be impacted by the technology. But the problem here, or the issue, the dilemma here, is that the technology could provide changes in the business model that will impact the whole. I have to say the whole framework around the solution. So it could impact the regulations. It could impact the facility that the solution is providing, and so. Let's be back a little bit for the concept of the tokenization. The concept of tokenization, which came actually out of the central banks and even out of the whole monetary system, it was related to shifting any value, regardless of the value, to something that is, I have to say, tangible, which is called a token, and then putting this token into a market where this token can be exchanged. So it's moving or shifting the whole value system from being just a money or maybe securities into something else. Even within the social media, if you have big number of fans, then this could be a token. If you have big number of maybe votes or blah blah blah, anything, it could be moved into a token, and then this token could be put into a market. The issue here is that how the society itself could be able to exchange this value between such token that could represent anything, that could represent assets or even non-tangible assets. So the central bank digital currency actually fits into this. The central bank digital currency, if we have a solution, if we have a system that is able to exchange with other tokens, then we are having some sort of a larger market for any value in the country. I'm not talking about something that will happen in the next few months or few years. I'm talking about something that could happen in the future. But it's always, I'm always thinking why the CBDC is something that people or maybe policymakers are thinking of. It's not only because it's providing a sort of digitalization, but because the whole trend right now is moving into, I have to say, a number of tokens that can be exchangeable. The other aspect that is extremely important when it comes to DLT is the programmability of the money. If you have a programmable money, then this means that you have a sort of a control to where the money should be paid, what aspects the money could be, provided. So you have sort of control, maybe a sort of a limit. So if thinking again of the a pandemic or where a government wants to reach to every single person and give them money that should be used possibly at the supermarket or the pharmacy only, then if the money is programmable, then the government will reach to every single citizen individually through his own token or wallet or account, and then the money will be controlled in a way that it could be disbursed only for buying foods or medicine or something like this. So here we are moving to I have to say, we are shifting the capability of the money, capability of the here if we are talking about social protection or anything like this, On the other side, this has an implication on the privacy. It has implication on other aspects. But again, it's all the time you have this trade-off between some controls versus the privacy and the other aspects. So that's the point here. Thank you.
Very good. Thank you very much. There was a question on the chat room in terms of implementing CDBC. If it's not DLT, what is the other technology that could be used to implement it? Any of the panelists would wish to answer that?
Sorry, could you repeat?
So if it's not DLT, what is the other technology outside of DLT and blockchain that could be used to develop a CDBC?
Let me, if I may take this, let me first start that DLT is, we shouldn't confuse two things here. One is how history has guided us here, and that is certainly right. We first saw Bitcoin, and then people started to think about CBDC. Then they saw private sector stablecoins that all, for no apparent reason, were actually claiming to be built on DLT. And now we're thinking about CBDC, but there is no intrinsic reason that we need to run it on DLT, right? So first, it's the default would actually be conventional systems, and they could be whatever. I mean, for historical reasons, right? These are built on old systems, but now might be a good point in time in history to update them, and they could even run, whatever allows for a high performance system. It could even be like a normal, Oracle database or something. Like it just needs to meet certain specification for encryption standards and protocols and how the commits are handled and so forth. So there's not even one specific technology. It's just that there is a vast range of technologies, and I think that will be the default. Well, central banks are certainly also looking into DLT, but I would answer it that way.
Okay. Thank you.
I would just add that, as Raphael said, there's a lot of different permutations and combinations. In fact, the most recent paper I think you published had a really nice diagram showing all the different sort of permutations and combinations within the DLT framework. So even a DLT framework can be not very distributed, so it almost approaches what would be a normal centralized database. But like I said, Uruguay, when they did their pilot, they found great success using the conventional, I don't know if it's Oracle or whatever, but a conventional, traditional, centralized database. It worked fine. They got very high transaction speeds. And that's another thing to mention, that some of the DLT technology may not be appropriate, particularly for large populations. It's interesting that the DLT experiments we've seen so far, like in the Bahamas and the ECCB, are fairly small economies, and so DLT might work there. But now you expand it out to a bigger country like Canada or Sweden. I think that getting the kind of transaction throughput that you can get with traditional databases could be challenging. I mean, that's not to say there was a comment about using Hedera Hashgraph to achieve higher speeds. And there's other technological solutions that claim to reach high levels of throughput, but there's challenges still on the DLT side.
Okay, very good. There is a question that we received from the Central Bank of Pakistan, and it is really dealing with developing country realities. So in developing countries, access to financial services is quite low. And in comparison, and similarly, internet access itself is limited in poor communities. Can CDBC services provided, for example, through the USSD channel on the mobile phone, on a feature phone, while ensuring the security component as an alternative to the channels that would be on a smartphone? So can the feature phone essentially be used for CDBC compared to a smartphone with a large internet connection? Any of the panelists?
I can jump in on that one, because that's why the Uruguay pilot, in fact, worked on that. It worked on a feature phone, so there's no reason why you can't run a CBDC on a feature phone. And another interesting option, the Bahamas Sand Dollar project, that runs on, I think that runs on standard smartphones, but their technology partner has figured out this system where they can basically throw up very quickly repeaters that allow them to achieve the smartphone data needs. They receive it through these very low cost, very quick to set up repeaters. So that's another option too for dealing with remote areas. They needed it particularly because they're a disaster prone country. So they may be in a position where the conventional infrastructure gets completely wiped out, and so they can very quickly bring these units in and get everyone back up to speed.
Mm-hmm. Thank you, John. Another question from
Yes,
please go ahead.
Interesting aspect here is also in terms of resilience, whether you design a setup which allows to combine on-chain and off-chain transactions, and how do you make sure that this is workable? And I think that is one of the major considerations, not just for developing countries, because also in developed countries, you need to think about disasters, extraordinary situations. And for this, to think about how can you still execute payments even if the networks are down is a key consideration.
Very good. So online, offline. Okay. Another question from Pakistan, Central Bank of Pakistan is a developing country. This is more with the user. You know, the people are used with cash, and cash dominates the use of payments. How do you introduce this cultural change for people to be moving to digital cash? Should there be regulation? Should there be an incentive in terms of credit? How would you motivate the user change?
Maybe if I could jump in here.
Sure.
The way I perceive it is that the central banks I talk to, they don't want to incentivize people to move away from cash. It's happening, right? And they're reacting to this. One aspect, one discussion one could have is that, as we've heard before, cash has costs and it's provided for free, right? So cash is subsidized today in many jurisdictions. And so the only motives I can really see to move away is because you do not want to subsidize that anymore. And then you could just stop doing that, right? But if I would come more from the other way, where sort of people that would like to pay in cash can't do it in certain circumstances, and how can we sort of make that? And again, right, we could start with situations where we have banknotes that have like a little field that you can rip off, and then while that is intact, the seal is on, they have a physical value, and once you rip that seal off, there is a code and that will give you digital value, and then obviously the bank. So and that is something that people will feel intuitively in the baseline use case, and when they need to, that's what they used to, and then in the digital use case, it's an easy bridge. Yeah. I think that's what we'll see.
In fact, Rafael, there is a question on the cost of cash versus CBDC from Joel Patenaude on the Q&A chat window. He says, could someone touch on the cost of cash versus CBDC and who benefits? Perhaps you or some other panelist could elaborate.
Anybody? Okay, so what I thought about this question, I think it's a good point, but then I thought about it again. Don't we? I mean, when there are local costs in cash use, and then there's the cost of the banknotes, and those tend to be printed by international companies, right? So we could see something where it's actually quite similar, right? I guess the technological basis, there are going to be some home-built solutions, but there are also going to be good solutions that are for purchase, the software and the hardware that are going to come from international firms. But then there's all the local operations, right? I mean, the interfaces are, and it's importantly, I think, is the KYC. And that has, axiomatically, it has to be local. So as long as you have local payment service providers, I think you will have local businesses.
Okay.
And one point we make in our paper is that the central bank who's going to issue CBDC has to dramatically beef up their cybersecurity operations. That's particularly true, I think, in some developing countries we've looked at that they're kicking the tires. They really are not ready. So they're going to have to hire some some IT specialists. So that's going to come from the local economy. Also, that cash is in most countries is not produced at home. There's the big companies like De La Rue and the Canadian Banknote Company that produce the banknotes for most countries. So yeah, I'm not so sure how. And of course, and there's the cash handling by the banks and so on. Well, you're going to have some kind of institution handling the digital currency. So again, I think it's a matter of replacing one kind of labor for another, but it's most likely to be local.
Yeah, and John, there is actually a question on that related to this, what you just touched on, from Mohammed Alam, who asks, what is the present status regarding competencies and preparation of developing countries across the globe to adopt CBDC as per IMF, World Bank, or other recent studies?
I'll let Ahmed take that one.
Okay.
Bilal, I have no idea about their readiness, but I have to say that issuing CBDC, especially if it is for the public, it will require huge changes in the structures of the central bank, in the internal organization structure, including if the central bank, for example, is directly in charge of operating the system, is directly in charge of managing the accounts, is directly in charge of opening, the customer support, all those aspects. I think if the central bank is in direct charge of those activities, then this will require some changes in the structure and some changes in the functionality of the central bank. If it is outsourced maybe to other financial providers, then maybe we may not need to see fundamental changes in the structure.
If I may perhaps add one aspect here, and it's not just the technological preparation, it's also the societal one. And I think here Sweden was quite exemplary in their discussions around their project for central bank digital currency, because they basically acknowledged not only it's a question of whether the central bank would have the mandate to issue a CBDC, but the central bank is entrusted by the society with certain tasks. So they basically said this is a question which needs a wider discussion involving parliament, involving the full population, as to what is actually desired in terms of the setup and the operation of the central bank. And I think that is a key aspect, because you need to underpin this with public support. You cannot just dump it from above.
Yes, and related to that, Klaus, there is a question from Marie Jordan about the readiness of the consumer, the user. How much education is required to really get the user on board and understand their privacy, other rights, and how to use CBDC?
Yeah, this ties in directly, and it's also a bit linked to the question of incentives that we had before. Like for any financial product, you need education, and you need to have financial awareness of the users. That holds true in general, not even for CBDC. So here is clearly a role for the public sector and for central banks to raise this level of understanding. And again, ultimately, it's in the interest of the central bank, because, as I said, it's a matter of trust in the currency. If the population doesn't fully understand or has doubts, the project will fail. So it is really indispensable to support it with a wide information campaign interaction with the public.
Very good. Any other panelists would like to address this, or should we take, there are a few more questions left. Okay, let's take the next question from Mohammed Alam. How a particular central bank take over the control on money supply rules of the country to formulate monetary policy in a DLT adopted environment of retail CBDC? Anyone?
I'm not claiming to be able to fully answer that, because I'm not a monetary policy expert. But my question would be how it would be different from the current determination of the supply of banknotes. I think it's exactly the same considerations that would have to be applied in the central bank when determining the volumes in issue, the money in circulation. So for me, it's not a novel aspect.
All right. Klaus, I think there was another question for you on how do you think fintech payment providers are able to provide cross-border payment at such competitive rates over banks?
I'm not sure whether the question really is well placed with me. Competitiveness is always a tricky issue because it relates on a number of factors. It relates on regulatory costs. It relates on access to particular services. So the question is not, you can't answer that in abstract. And from that perspective, of course, it really depends on what would be the concrete business model of a provider. How does it integrate? How does it is supported by both the sending and receiving jurisdiction? In this level of abstractness, I'm afraid I can't provide a useful answer.
Fair enough. We have one last question from Shalva. The question is to all the panelists. In your view, what payment system design features seem the most potent in dealing with the possible financial stability concerns related to widespread adoption of CBDC, risks of bank runs and dissemination and disintermediation? Thanks. Anyone?
I'll jump in. This is a personal opinion only. I mean, I mentioned earlier that how most of these pilots and explorers are not contemplating making the CBDC interest bearing. I think that's something that they should think more seriously about and make it a variable interest rate that can be used to calibrate demand for the currency. I think that would be a key factor, or introduce some kind of fee structure, but really the same thing. You're technologically speaking, having variable interest rates or fees is identical, really. Other than that, I think I mentioned earlier the need for some kind of limit structures. Perhaps transaction limits could be part of that that containment of disintermediation risk.
If I may add to this, I think there are two sides here. One is certainly these technological elements, right? And a lot of technology, these economic elements of interest rates and caps, where we think caps can never be hard, right? It's not that suddenly you reach a certain balance and then you can't accept incoming payments, but caps where you have very unfavorable interest rates once your balance exceeds a certain limit. So that will limit the inflows. And second, also, what we are really worried about is like self-enforcing runs, right? Because you can easily switch into CBDC that facilitates bank runs. But again, right, central banking is so much about trust. And if the central bank commits and communicates that in such case, it will simply re-liquidate the banking systems, you can eradicate such feedback loops. So it's about economic means, but again, also a lot about trust building by central banks.
Also, further to one of the things that Raphael said, that he mentioned the hard limits, and that's true. That I don't think you could possibly have hard limits, because as you're floating around your country with your device and people are giving you money, there's a risk that you'll go through any kind of limit without knowing it. But the way the Bahamas Sand Dollar project deals with this is called a waterfall approach. So for people with those people that have the higher KYC and so on, they also are required to have a bank account into which excess money flows. So as soon as you hit that limit, that goes into a commercial bank account. That solves the disintermediation problem right away, because it just keeps going back into the bank every time you try to get it out of there.
Very good. Well, thank you very much. I think it's time for us to wrap up. It was a very rich session looking at CBDC from different angles, from world experts on the topic, from various world organizations working in this area. So I'd like to thank you very much, our panelists, and I would like to wrap up now. Thank you all, also for everyone who's participating, for your questions in today's webinar. And I wish to invite all of you to our next episode on digital currency on Monday, 29th of June. where we will be discussing the applications of digital currencies and the areas where technical standards are needed. We will also have an announcement to make on Monday about a new partnership on digital currency, but I will leave the announcement to Monday. So you can tune in and participate in the webinar and hear our new announcement of this partnership. And with that, I would like to really thank very much our panelists. Really appreciate your time with us today. Thank everyone for their participation. Everything we have done today is available on our website, on the ITU website, webinar series. A recording of the session, as well as all the presentations for this episode and the previous ones are all available. Wish everyone a nice day, evening, and declare this webinar closed. Thank you very much.